Hello, everyone. Welcome to our fifth episode of the UPE podcast series, a series for UPE members by the UPE Alumni Committee. Each episode, we will have an amazing guest or two on there as they share their stories, experiences, and insights for all of our listeners' pleasure. The specific topic of today's podcast is financial literacy. My name is Dylan, and I'll be your host today. Um, I am joined with Devan Dutta, an esteemed UPE UCLA alumni. Devin, it's great to have you here. How are you doing today?
I'm doing well. How about you, Dylan?
Yeah, pretty good. Um, we're on the hump day of the week, so hopefully,
Perfect day for an interview, right?
exactly. Um, Before we begin, could you give a short introduction about yourself, including your graduation year, the current company you work for, and your involvements at UPE when you were an undergrad?
Sure, absolutely. So yeah, as Dylan mentioned, my name is Devan. I'm a software engineer working in Wing, which is an alphabet other bet. We do autonomous drone delivery. Prior to that, I was at Lyft's level 5, the self-driving division. So I like to joke with people that I'm basically just doing the Back to the Future plot, start on the road and then go to the sky. But yeah, that's the background on me. Outside of work, I really enjoy blogging, specifically for computer science, finance, and investing. I do a lot of mentorship. I've been a DJ for more than 12 years, and I really enjoy driving. So I'll just pick, a certain landmark to drive to on the weekend, go there and check it out. Okay, your other questions. Let's see. Grad year, that was 2019, and then involvement in UPE, right?
Yes.
Okay, so I was a mentorship chair back then, which I guess makes sense now given the mentorship that I do and the stuff that I read about in my blog. But yeah, that's what I did in UPE.
Awesome. So yeah, one of your interests, finances. This will be very relevant for this podcast. So I guess jumping right into it, how would you define financial literacy and why should people gain it?
Very good question, Dylan. I guess we should take a look at both parts of it, right? The financial and the literacy. Financial comes from, well, finance, and finance is just anything that deals with money and investments, right? Whether that's an individual, a company, a government, how they get money, how they spend money, how they invest that money, right? So I guess with personal finance or personal financial literacy, what it comes down to is how well do you understand financial topics to be able to make informed decisions about using your money well, right? Budgets, debt, investing, basically living the best life that you can with, the monetary means that you have.
Awesome. Yeah, those are very useful things to know, especially working in tech. And kind of transitioning into that, a lot of times you'll see um, numbers about like salary or total compensation, and a lot of times it can be hard to kind of decipher what the difference between these two is. So um, if you could enlighten us to what the difference between salary and total comp is.
Absolutely. Yeah. So I write about this actually in my blog because I get a lot of questions from new grads and also people who are still in school, right? Because they're trying to evaluate all these different SWE offers and they're like, none of the numbers are like exactly the same. How am I supposed to compare, apples to apples? So there are like three main components that you would have in any SWE offer, and it happens for many other kinds of offers too in tech companies that are not specifically for SWE roles. But you've got, your base compensation, which is your salary. You normally have a form of equity, think RSUs or something like that. And then you've got a bonus, right? And the bonus can be on some kind of target or it could be fixed in a given year. Those are the main components that you've got for compensation, right? The things that are consistently coming into you, like every single paycheck, would be your salary. RSUs would only start vesting after a year. And then let's see, the bonus would be like normally a lump sum that's paid to you at the beginning of the next, fiscal year for that company.
Cool. And then kind of branching off of that, at a very high level, how does equity compensation work in specific RSUs?
Yeah, that's a great question. So okay, a little bit of history, but back in the early 2000s, there were quite a few accounting scandals. Enron was one of them, and it was mostly coming from the use of stock options and people trying to evade paying taxes, right? So RSUs actually have existed for quite some time. It's just that they weren't like a standard form of compensation for anyone who was below an executive level. And after all of these accounting scandals, then people started realizing, hey, there's a way that we could both follow the law and give people better compensation and give them, an interest in working in the company that they're in so that they stay, right?
Yeah.
That's where RSUs came from. That stands for restricted stock unit. And depending on the company, right? Let's say it's a public company, it's the same as any other share of stock that, someone would buy or sell on, any market. The difference though is that it's granted to you normally when you join. And then every year thereafter, there's like a re-up grant, right? So the company is giving you your stake in that company, right? And it's growing over time as you get more equity. And this can be a very, very effective form of compensation. If the company is doing well, and you keep getting re-up grants, right, based on your performance and just, annual refreshes, you can build up a sizable amount of wealth that's coming in just the form of, equity in that company. And then when you want to go and buy a house or something like that, you can sell a bunch of those positions, or you could even be continuously selling them and reinvesting them in your own ventures.
Oh, I see. Yes, this seems like sort of a win-win for both employee and employer. Um, and so, kind of wrapping up this topic, how much should you weigh your compensation when deciding on an offer, in your opinion? I guess it's a very subjective question.
Yeah, that's a good question. As a new grad, you don't have tons of leverage, right? You're mostly just like shotgun, sending out your application to all these companies. And you're like, okay, I hope one of these sticks. I hope I'm able to get through, the interviews. The good news though is that if you're at UCLA, you definitely have, the intelligence to be able to do it, and the base skills that you need. So yeah, how do I explain this? I guess if you're looking at the total compensation and you say, this is the highest one, I should choose this one, I think that's the wrong way of doing it. Instead, what you should consider are the other aspects of the job, right? Like, where is it? Am I going to be near my family, or am I going to be moving across the country? Do I have any friends there? Do I feel, comfortable in the city, town, wherever it's going to be? Do I want to begin my career there, right? Secondly, do you enjoy what you're going to be working on? There are plenty of people who could pick, very high paying jobs and just hate what they do and not like coming into work every day. That's definitely not a good way to start your career. And another thing that you should probably consider too is, how do you feel about the company? I know that this is like a super vague way of explaining it, but normally when you're interviewing at a company, you start getting a sense of its culture based on the interviews that you have, right? If you didn't really get along with the interviewers, or you thought that the recruiters were being very pushy and weren't answering your questions, that might be an indicator of what the company culture is actually like, right? So your gut feel is also incredibly important to you too. How you weigh all three of those things, like the total comp, what you're going to be working on, and the culture, that's up to you. I mean, some people would say, what is the beginning of my career? I should just be picking the most high paying thing possible to make, a solid foundation for myself. But I would argue against it. I think you should focus more on learning and culture, and seeing, how you can blossom your career from the beginning.
Yeah, for sure. And definitely those experiences early in your career will help you set you up for hopefully better opportunities and better compensation down the road. So now that let's say you've accepted an offer, you have a job, you have a lot of money coming in, how should you be tracking all of your expenses and making sure that you're not that you're putting your money in the right places?
That's a good one, actually, Dylan. As soon as you get that offer, right, and you start seeing the money come in, you're like, oh my God, this is such a fat paycheck. Like, I am going to be a king. Yeah, initially it's going to feel that way. And then, adulthood is going to set in. You're going to be like, oh my God, there's so much stuff I have to pay for. So yeah, it's a very good question that you asked. I think that when you're trying to budget things, there are certain classes or categories, right, that you can consider. And you don't actually have to come up with all of them yourself. There are very, very good financial planning apps, think like Mint from Intuit, that will go through all of the accounts that you link. And I think they will scrape like the last 3 months of transactions just to seed some information in the system. But from that point on, every new transaction that comes in through those accounts, it's already categorizing for you. So you can see your run rate in terms of like, I'm buying this much in groceries, I'm spending this much at the movies, I'm, going out to restaurants at, this clip and with this average cost per trip. All of those are very, very good to have. But before you even get to that point, when like the money has just started coming in, right, you need to figure out what your base expenses are. And the base ones are going to be rents, right? Because you're most likely going to be living in an apartment or something like that. If you happen to be close to home, maybe you can live at home and then you don't have to pay for that fee or that charge. The second one would be food, right? If you're living on your own, then you're going to have to set some budgets for how many, trips to the grocery store you're going to have, what sorts of things you're going to buy. And the third one might be car fees, right? Like if you got to drive, in the Bay Area, especially, right? In many of the towns, unlike San Francisco, it's pretty common for you to have to drive in order to get to work, right? Rather than taking public transit. So gas costs and that sort of thing. From that point on, the rest of it is discretionary, right? Some of it you should be saving, some of it you should be investing. Don't just like blow it all on, very expensive dinners or something like that. It's good for you to enjoy your life, and you definitely should have larger purchases from time to time that are going to give you joy, right? Don't just like be constantly hoarding everything because you're afraid. Yeah, find a way to live for the present while building for the future.
Awesome. Yeah, thank you for the mint suggestion. I've naively been just using Google Sheets, and I have to like go through all of my receipts and stuff like that. But yeah, that's
I think
cool.
Google Sheets is a fantastic way to start. That's actually how I began, even at
Okay.
UCLA. I would take a look at a receipt that I got from Ralph's, right, or Trader Joe's, and I would be like, okay, it looks like the cost of milk is going up over time, and I would actually, put in line items for every single thing that I bought. And that's how I knew, like month to month or even week to week, like exactly how much I was spending. So it's great that you're starting that way. Mint won't be able to tell you like each of the line items for the thing that you bought, but it will say like you went to Safeway and you spent $30 or something like that.
Okay, for sure. I will start using, I guess, both in my budgeting. Um, we kind of got off that point. What kind of strategies do you employ? You personally, do you partition your paychecks into sections? Like this is how much I can use for food and rent, and just kind of like other non-essentials that I like to do, or how do you personally handle that?
Yeah, good question. So there are ways actually, depending on the maturity of your tech company, to partition a paycheck. Like it will literally have split out, items for whatever you want them to be. Internet reimbursement was actually a very common one during the pandemic, right? People were working from home, so many tech companies were like, okay, we'll cover your internet bill, and that would be a separate line item that was split out, in your paycheck.
Oh.
That being said, it's not common for companies to, have separate categories of transactions that you can split out in a paycheck. They'll normally just say like, this is how much you were paid, this is how much went as a 401k, this is how much we paid towards, benefits that you elected, and that sort of thing, right? Oh, and then taxes, of course. So I think it's a better idea to take a look at your monthly paycheck and say, how much did I actually walk away with, right? Because what you're paid is not actually what you get due to taxes. And within the first like 2 or 3 months, you're going to know exactly what that is, right? Whether Mint has told you or you've just seen the numbers yourself by looking at your paycheck saying like, okay, this is what I was paid, this is how much was taken out in taxes, right? From there, you can then say, okay, I'm going to subtract out all the necessary stuff, right? Rent, utilities, gas cost, food, all that stuff, right? Now, what am I left with, right? And the what am I left with part is the most important part of your question, because that's the most like vague part about how people subdivide the money that they have left, right? They can choose to spend it all, they can invest it, they can save. So what I like to do is I like to set aside a portion that's going to be meant for investing, and then another portion that's going to be set aside for just discretionary spending. And that discretionary spending will also include an area for just saving if I happen to not use that discretionary spending, right? Depending on the next financial goal that you have, you might want to save more, or you might feel like, you know what, I've gotten to a happy place, like I'm okay having a little bit more discretionary spending. And that's why that last category can sometimes fluctuate for me. But yeah, having that run rate, I think, is the most important part initially, because you don't actually go home with exactly what you were paid due to taxes.
Awesome. Yeah, and I guess that's why go back to the previous section, um uh like tracking your expenses is really important. So you know how much to set aside. And yeah, I guess on the topic of savings, now we can transition to bank accounts. Um, for those who are unaware, what is the difference between like a checking and a savings account?
Yeah, good question. Checking was designed to allow free money flow in and money flow out, right? Like as easy as you possibly can to move money in and out. That's what a checking account is supposed to do. A savings account, on the other hand, is, well, based on the name, meant for savings. So it generally has a better interest rate that it's paying, although it's not going to be significantly more for certain banks, right? Between like a checking and saving. There are some banks actually that will do what are called sweeps, where they will do, trying to think of the right way of saying this. They'll take a bunch of money that you have deposited with them and sweep it to other FDIC insured banks that in aggregate will give them a certain interest percentage back to you, right? And those kinds of banks don't have a massive distinction between like checking and saving in terms of interest rate. But checking is like a functionality sort of thing, right? Like being able to write checks or have direct deposit coming in. That's what checking is for. Saving is just, I'm leaving money there. I'm going to try to save it. This is the interest rate that I'm going to get. I like to tell people that like you should not be just putting a bunch of money into savings, because it's probably not going to keep up with inflation. It's always good to have some money set aside because you need some liquid cash. That's what the saving is for, right? But if you wanted to, and the interest rates were roughly the same, if you just open a checking account to allow money to come in and money to go out through Venmo, direct deposit, however that may be, you probably would be fine. People who decide to have the checking and the saving, that could be either a legacy thing from an old bank where they just automatically open two accounts for them, or they made a decision and they said, you know what, this interest rate is way better with the savings account. I'm going to have two different kinds of accounts.
See, I guess beyond those two types of accounts, are there any other types of bank accounts that like the average person should have?
I mean, there are other non-standard kinds of accounts that you can have, right? Like a CD, certificate of deposit. And what that does is it basically locks up your money for some period of time and then gives it back to you with some interest, right? And the interest rate is decided at the moment that you open that account and put money into it. So that's another approach to, I'm going to set aside some money and just not touch it, kind of similar to savings, but a little bit more locked down. The last kind of account that I would describe, because Fidelity, for example, does this, is a brokerage account, right? A lot of people want to invest in stocks, and I've personally found Fidelity to be fantastic. I think that they have very, very good integration with their checking, saving, and brokerage account, so that you can see everything in like one dashboard. But there are other banks that will do this as well. So yeah, it's totally up to your preference. You could also just completely separate the two and say, I want my banking to be for banking, and I want, I don't know, Robinhood or some other kind of trading platform to be for brokerage. That's totally fine too.
Okay. Oh, cool. And this last question here would be, what is an emergency fund? And how much money should you put in one?
Yeah, emergency funds are a dicey topic for people that are first beginning their careers, because they really don't want to think about it, right? They're just like, okay, I have to set aside money in case something bad happens. That's very ominous. It doesn't have to be something bad, right? It could just be, you know what? I realized that I'm not at the right company. I have not lined up something else yet, but I am super burnt out and I just want to leave. And the emergency fund allows you to do that. It's sad that you had to leave, obviously, right? Because it was not the great culture, but you don't have to worry now about no income coming in because you've got this emergency fund. Emergency funds can also handle things that are just entirely unexpected, not related to compensation. It could just be like, I got a root canal that I have to take care of, and my dental insurance is not going to cover all of it, something like that. So it's always a good idea to have an emergency fund. I think your next question was, how much money should you put into one?
Yes.
Okay, so this varies depending on what your standard operating expenses are, right? If you're spending a lot of money every single month, then it really needs to be higher. If you're barely spending any money per month, maybe because you're living with your family at the beginning of your career, then it doesn't have to be as large. I generally say like 3 to 6 months. That's a good one. The reason why you should skew more towards the 6 months actually is because when you're trying to go for a mortgage, right? You found the perfect place and you want to actually buy it now, your first home purchase. What the bank is going to do, the one who's underwriting the mortgage, is they're going to try to figure out what is your reserve. So when you've liquidated a bunch of assets because you've got equity growth from RSUs or your own investments, and you're using liquid cash that's in your account to pay everything, after all that's said and done, how much money do you have left over, right? And what they generally aim for, if it's, you know, a jumbo loan for 30-year fixed, is 6 months, 6 to 12 months, right? So if you've already got that emergency fund set up, that's there. It's already, you know, you've got some solid principle in it, and you can keep adding stuff to it if you needed to. And that's really going to help you in the future.
Awesome. And generally, would you put this money like in a savings account?
Yeah, I think that that's a good idea because you want it to still be liquid, right? You don't want the certificate of deposit approach that I talked about because it would be locked up for some period of time before you can touch it, right? Savings account would be a good choice, or if you wanted to just make it like another checking account, right, and call it something different, you could do that. For example, when I'm paying property taxes, I actually have 2 different accounts that I've set up such that I can have one for direct deposit and I can have another one that is just an allocation for property taxes. And I'll just manually move money around in order to, you know, have a reserve set aside per month to pay property taxes. When property tax season comes around, I then use that second checking account, the property tax one, and I've already got the money there because month to month I've been adding it in.
Awesome. I guess on the topic of like spending, we talk about credit cards. So why is it important to build credit?
Yeah, that's a good question. I had a lot of international people in my first role, and actually second role, the current one, asked me this too. It's different from other countries, right? Because in a lot of other countries, you would just use a debit card and directly pay for your transactions, right? Like, why is it in the US that we care about credit so much? A lot of our financial ecosystem is built on credit. When you want to go and buy a car, they're pulling your credit score. When you want to go and buy a house, they're pulling your credit score. When you're applying for a new credit card, which is still building credit, they're, you know, pulling your credit score as well. So because your credit score is incredibly important, you need to be able to build this credit, right? You need to show that you are a reliable person to loan money to, and that you are going to keep paying back your debts at a reasonable rate, right? So that's why you want to build credit, because everything else in the US that depends on it requires that you have a credit score and your credit score is good. I guess the other reason why it might be good for you to do so is because if you can establish a good routine of spending within your means and not exceeding, you know, your credit limit, right? And actually you should be far under that. It's reliable, good money skills to have, right? Like internally, you know, like I've been given this massive amount of money in the form of, you know, a credit limit, and I'm not going to keep on spending this. Like I have discipline, right? So I think it's good in both those ways. One, because you need a good credit score, and secondly, because you're teaching yourself how to be fiscally responsible.
Um, and so when trying to build credit, what should you look for when selecting like a credit card?
Yeah, very good question. I'm guessing fees are probably one of the things you're going to ask about.
Yes, yes.
Okay. Yeah. So most credit cards, like no frills ones, it's kind of a no-brainer in terms of choosing which one. It's mostly going to be dictated by the bank that you're in, because many of these large banks will have like credit card partnerships with, let's say, MasterCard, Visa, something like that, right? And you'll basically just say, you know what, I'm of age, I would like to have a credit card because I'm going to, you know, have some transactions that will be based on credit spending. Which credit card would you recommend? And they'll give you one, right? Then there are another tier of credit cards that you'll find that will have reward points, right? Maybe they're static, it's just constantly 2 times the number of points for dollars that are spent or something like that. And you could have others that are different where they say, we'll give you 4% cash back, like not even rewards points, if you buy gas from Costco, right? Because that's one benefit that they would provide. So you have to weigh all of the benefits that you would like from a credit card with the cost of having that credit card. And for the cards that have fees, they generally come with a lot of other benefits that are particular to the person who would be best suited for that card, right? So if you have an Amex that has a lot of really, really good travel credits, maybe you want that one, even though it has a fee because you travel a lot. The net result to you is that the value of the benefits that you're using is more than the cost of paying for the card, right? You always want to pick a card that's going to offer you more than what you're going to pay for it. And that's why just simply having a fee is not necessarily a reason to like remove a credit card from consideration. But it may be if, those fees are excessive and you don't think you're going to use all of those things.
And for those who are unaware, what is cashback?
Oh, yeah, that's a good question. So, okay, let me start with reward points and then I'll talk about cashback. So, because a lot of things in the US are based on consumer spending, right? We want to continually have money flowing through the economy. Credit card companies started partnering with many other industries, think like hotels, travel, food, right? To allow for consumers who are spending at those places to rack up what are called reward points. And when you hit a certain number of reward points, you can then redeem them to be able to get some other product or service, right? A really common one is airline miles, right? You're using some credit card that's helping you rack up airline miles, or they're actually just straight reward points that turn into airline fare for you, right? So that's option one for a credit card that's giving you rewards. Option two is cashback, where they basically say, okay, you built up a lot of transactions that you use with us, right? The total value of these transactions is X. We're going to give you 4% of X back year over year, right? That's like the Costco model. So if you get like a Costco Visa, they're going to give you a cash back for the total, value of the transactions that you have. Cashback is a little bit different from rewards points because you don't just like redeem them to get a product and service. They're turning into cash, which you will then use to buy said product or service in the future.
Awesome. So now you've like looked through all the credit card options, you've chosen a credit card. How should you be using your credit card? Like how much of your limit should you be using? How often should you be using it? How often should you pay off the balance? Stuff like that.
Got it. So luckily the answer to how much of my credit limit should I use is fairly standard. I mean, Mint and Credit Karma also both through Intuit, right? Credit Karma as well. Will tell you like, do not ever exceed 30% of your combined credit limit because you could have like other, credit cards given to you as well. But I tend to find that under 10% is like the sweet spot. That's where you want to be. The reason why is because if you're consistently under 10%, it'll help you build your credit score faster than if you're racking up more debt and then, paying it, right? There are two things that, credit score agencies are looking for, which is one, reliability, that you are consistently paying off your debts, right? And secondly, that your debts are not like skyrocketing and then dropping and skyrocketing and dropping, right? They should be relatively constant and low. So if you keep it under 10%, that's a great way to do it. Now, the next question that I normally get from people is, how am I supposed to keep it under 10%? The cost of living is so high in California. If I'm constantly using my credit card, right, I'm going to go over 10%. There are two things that you can do, right? The first one is you can keep paying it back as frequently as you were spending, for the credit card. So if you spend, $50 today, tomorrow you go into that account and you credit $50 to it, right? Or something like that. The second way that you can do it is you could, depending on how long you've had a credit history, argue for a higher credit limit. And the benefit of doing that is you're not actually going to use up any more of your credit limit. It's just you want a higher limit so that your relative percentage is lower for your debt spending, right? And as you get older and you have other credit cards, either because you open new bank accounts where, you know, it was a good idea to have a credit card with them, or you wanted a credit card for rewards or something like that, each of those credit cards are adding more to your total credit limit, right? And if the cost of all the stuff that you're buying month over month is not really changing, then that relative percentage is going to keep dropping, right? In terms of your debt utilization. I think the next thing that you had asked about was how often should you use it, right?
Yeah.
Okay. I tend to use my credit card for basically everything except for very, very large transactions, right? If I'm paying property taxes, or I'm, you know, paying federal or state taxes, you know, at the end of the year because I owe taxes rather than getting a refund. All of that is coming from a digital transaction that's occurring through my bank to whoever I need to pay, right? Likewise, if you're buying a car, you're probably not just going to like pull out your credit card and be like, okay, $60,000 for this Tesla or whatever it might be. You're definitely not going to do that. So yeah, I think that for most day-to-day transactions, credit card is perfectly fine. And especially with the advent of, you know, like Apple Pay, where I can just like pull up my Apple Watch, double tap the side, right near a reader. It's just so easy to do so. You don't even need to pull out the credit card anymore. That is a little bit dangerous, right? Because they made it easier for you to keep on purchasing things, and many online websites don't even need you to like keep entering your credit card info either. They could go through Apple Pay too. So yeah, keep that in check. But otherwise, I think day-to-day transactions, perfectly fine to do it.
Awesome. And just a few follow-ups to that. You mentioned like appealing to, or um, requesting a credit bump. How would you do that? Would you go through your credit card company? Is there like a, um, is there someone you should email? How does that work?
It's normally the bank where you got that credit card, right? So as an example, let's say you go to a credit union and you say, hey, I've had, you know, a savings and checking account with you for 2 years, or maybe you're a brand new customer. Many of these credit unions will still be able to help you. I'd like to have a Visa credit card with, you know, this credit limit, right? They'll ask for a bunch of financial documentation from you that basically proves that you have the income that could support this kind of credit card. And then they'll say, okay, we'll underwrite you for this value, right? When I first, you know, began my career, I guess as an intern, right? It wasn't even full-time. That's when I got my first credit card. I just gave them a few paychecks and I showed them the value that was, you know, in my accounts, because they know that, right? It's internal to them. And they were like, okay, we feel comfortable underwriting you for this credit limit. And at the time it was so high that like, I never even went back and asked them for an increase. 3 years later, they then were like, you know, we do have this other credit card that we think might be better for you. And we're able to give it to you for free. Like there are no fees and you're going to get better reward points. And I'm like, okay, what about the credit limit? They're like, oh yeah, we'll bump that up as well. You just don't have to use the other one anymore. And I was like, oh, nice. Okay. So I didn't even have to do anything. That being said, though, if they come out with a certain credit limit for you and they didn't ask for any like financial documentation to begin with, like all they did was ask you to input what your, you know, monthly salary was or something like that. Chances are, if you provide them with more financial documentation that proves, you know what, I could have a higher credit limit than this, they might be willing to do so. There are other banks though where they're just like, you know what, no, we've underwritten you for this amount. Like you have to generate a bit more history with us, and that's okay too.
Okay, awesome. I just also like just personal question that I have is, let's say you have like a, I don't know, $1,000 credit limit. You want to buy something that's like um $600. Should you just pay using like your debit, or um using like just cash instead of using your credit card?
Yeah, I actually had exactly this happen. So when I first began with a credit card, it was a $1,000 credit limit. And I forget exactly what it was that I was trying to buy, but it was something in the multi hundreds, right? It was like some consumer product. Um, and I was like, okay, do I use the credit card, which can definitely cover this, or do I just like write a check? Like, how do I ended up going with the credit card just because it was a way more convenient option, right? And then like literally the next day, I just, you know, deposited that value into the credit card account and it was marked as paid. So by the time I got my credit card statement, like that charge was not even there in terms of like adding up to something that I needed to owe. Of course, it's there to prove that, there was a transaction that was made. But when they then said what you owe, it was like $0 at the end. So I guess this kind of goes into like the how often should you pay off your balances thing. I'm a little bit of a control nut. I like to just continually keep paying off balances at, let's say like twice a week, something like that. If it's a fairly large purchase and I just don't want it to be using up that much of my credit limit, maybe I'll take care of it sooner. But yeah, the two things you need to keep in mind are, one, make sure that you're always spending within your means, so less than that 10% if you can. If it's occasionally going to go over that, then might be okay, but like very rarely, right? And secondly, it's perfectly okay if you don't want to be a control freak to just keep doing it on monthly increments too, right? That's the point of a monthly credit card transaction bill, right? They'll just send you something in the mail or over email saying, okay, this is how much you spent over this month. This is how much you owe us, right? Plenty of people have done that, right, and continue to do that. I tend to not do it just because I don't like seeing that there's debt that I have to pay.
Yeah. Awesome. Yeah, I could definitely relate because I used to just wait for like the monthly payment to happen. And then I saw like my credit card score was like dropping like a few points. And so after that, I was just like every single day, like checking to make sure, then paying it off immediately.
Yeah, when you first are building up credit, your credit score is going to have a lot of fluctuations. If they're like, single digit fluctuations, I wouldn't worry about that. If they drop by like 40 points or something, then I would be like, okay, that's strange. Another thing to keep in mind though, is that there are three different, credit reporting agencies. There's Equifax, Experian, and TransUnion. And all three of them come up with different credit scores. So the data that they're getting is roughly the same, but the algorithms that they're using can be sometimes different. That's why it's a good idea to have those two apps that I mentioned, Mint and Credit Karma, and there are a few others as well. Your own bank might actually have something for you, like check your credit score for free, where they will show you like among the three credit bureaus, what is your credit score. And Credit Karma will actually do a thing where it'll show you like this little chart over 3, 6 months and a year, saying like, okay, this is how your credit score has been changing, right? And if you see that it's relatively constant and it's going up at a slow clip, that's perfectly fine. That's what you want. If it's going down and like precipitously drops, it's probably because of a large purchase.
Okay, awesome. And I guess also just another question is, when you're, I guess, applying for a loan or like trying to get a mortgage, I'm assuming there shouldn't be like too much difference between the different credit bureaus, but is usually kind of random for which one they check, or
yeah, so when they're checking your credit score for something like buying a car or buying a house, they're doing what's called a hard inquiry check. So there are two different ways of checking a credit score. There's a soft check and then there's a hard check. Soft check does not hurt your credit score. It's basically just like, the same thing that you would do by going into Credit Karma, Mint, or your bank's portal and saying like, okay, what is my credit score? The hard inquiry, though, is more detailed and it will actually drop your credit score by just a little bit. The hard inquiry check is normally to one credit bureau that is, I guess, like partnered with the company that they use to do the hard inquiry check. So if you go to like a car dealership and you want them to run your credit, that car dealership is not going to like directly contact Experian in most cases. They'll contact some other intermediary. And that intermediary will say, okay, I have a partnership with Experian, so I'm going to do the hard inquiry check with your Experian credit score, right? But a different financial institution might go with TransUnion, for example. You don't really get to control that. There isn't a massive distinction between the scores. Like I haven't seen that many cases where like you would have just like a 50-point difference between like any one of those three and then another one. But yeah, like I was saying before, single digit differences, that's entirely possible.
Awesome. And kind of circling back to earlier you mentioned brokerage accounts and investing. If we can just talk about like some investing fundamentals. Obviously a very complicated topic, but can just hit like the base level. A lot of people would ask like, isn't the stock market dangerous? Why is it better to invest money versus putting it into a savings account? I guess you kind of touched on that earlier with inflation and stuff, but yeah.
Okay, yeah, I can go into that a bit. Yeah, so stock investing can be definitely depends on what your risk tolerance is and what kind of reward that you want, right? There's a spectrum where you can basically say more risk, potentially more reward, less risk, less reward. Keeping your money in a savings account is pretty low risk, right? It's FDIC insured. It's not really going to be investing in tech companies, right? It's just money that's sitting there with a certain interest rate that's given back to you. The problem, though, like I was mentioning earlier, is that it's probably not going to keep up with inflation, especially now, given that inflation is growing rapidly. So if you just wanted to keep up with inflation, right, like you wanted to preserve your capital, you didn't really want to grow it, maybe then you would start investing in bonds, right? Because bonds will give you a certain known return rate over time. And many of them have coupons that will continually pay back stuff to you per month until, you know, the bonds duration is done, right? So that's the next step. Then the step after that would be, okay, I'm going to invest in stocks, right? And especially with like this meme stock craze that happened during the pandemic, a lot of people were like, oh my God, I can make money like super fast. Not so fast. Yes, there were some very strange things that happened during the pandemic with like AMC, GameStop, that sort of thing, right? It does not happen frequently, and it's very hard to guess if you're going to be on the winning side, right? A thing that compounded that was that people were using a lot of options contracts to be able to have larger leverage. So if you just want to get started with stock investing and you just want, you know, it's slow, steady trickle of money, right, going into investing in stocks, and you want to see if they're going to grow, I would highly recommend looking into what are called index funds. Index funds are meant to track a particular index. Think the S&P 500 or NASDAQ or the Dow Jones. And because you can't buy into an index, instead these index funds are created and their makeup or their composition matches that of the index. So if, for example, I don't know, in the NASDAQ 100, this isn't true, but let's say that the NASDAQ 100 had 10% Apple, right? The index fund that tracks the NASDAQ 100 is going to have 10% of Apple in its portfolio, right? So by buying just one share of this index fund, you effectively get a sampling of all the companies that are in the index, right? And that's a fairly low risk way to begin, right? Because you don't have to pick like individual equities to invest in. You're just investing in the index itself. And if you look at these indices over time, the Dow Jones, S&P 500, NASDAQ, even the semiconductor indices, right? They've been going up consistently over time, right? If you look at like decades long, right? So if you think about it as a long-term investing strategy, it will do better than inflation, it will do better than bonds, and you're going to be able to grow your capital. That's not to say that like within 2 or even 3 year increments, you're going to see massive downturns occasionally and then it goes up again, right? That's why you just do a thing that's called dollar cost averaging, where you basically say every month I'm putting in $100 or every month I'm putting in 1,000, right? Or some percentage of my paycheck. And by doing that, you're going to catch the dips, you're going to catch the highs, but net, it's going to average out to you're consistently investing and getting gains, right? You can pick wrong. That is part of the risk of stock trade, right? If you pick a single equity that doesn't do well, you can lose your investment in it, or maybe you'll just be sitting there waiting for a very long time for it to come back, and it might never, right? So yeah, there's absolutely a risk in that. There's a post that I wrote on my blog about this where I talk about the relative performance of those 3 indices, the Dow Jones, the NASDAQ, and the S&P, and give you a few recommendations about different index funds through Vanguard or Spider, for example, that you can invest in.
Okay, cool. And for everyone watching, I'll link Devan's blog in the description. One thing you mentioned was how index funds might be a little more risk, but like high reward, and also how bonds be kind of lower risk but lower reward. What is a bond?
Yeah, good question. Okay, so imagine that your local government, just like city of San Francisco, wants to build something new, a high-speed rail, waterfront pier, whatever it might be. They need some money in order to be able to do that, right? And they can't just depend solely on the state to be able to give them money from state taxes that people have paid. So instead, what they do is they open up bonds that people can buy, where they are fueling that endeavor, right? Building whatever it might be, because they've bought these bonds. But what the city is doing is they're saying, not only are we going to pay you back the principal that you gave us, but we're going to give you some interest, right? That's effectively what a bond is. Bonds come in all shapes and sizes. Some of them don't have coupons, some of them do, some of them have, 10-year duration, some of them are way shorter. They also have ratings, right? So if a certain bond issuer is not reliable, they're going to have a very low rating for their bond. It used to be the case back in like the early 90s or something, because that's when I was born. I got a lot of gifts from people upon my birth in the form of like bonds. I was like, I don't know why that is. So what ends up happening after the bond matures is it's just value that's sitting there, right? Like it's actually going to go down in value over time because you're not consistently getting any more money from that bond issuer. But at the time, I don't know, a lot of people were just giving me bonds. Now what bonds are used for people who are just beginning their career, is capital preservation, right? If you're choosing to invest in them. So if you've got a 401k fund at a company that's doing what's called a target date retirement fund, meaning like we are aiming for you to retire by this age or something like that, there's normally an asset mix that is part stocks and part bonds. And some of those stocks could be index funds, some of them could be, single name equity, but there's also bonds, right? So when you're first beginning, that target date fund is going to lean more heavily towards stocks, right? Because your time horizon is longer. You don't need to preserve your capital for as long. You want it to grow rather, right? And as you get older, that shift is going to start happening where it starts going back towards bonds and less towards stocks, right?
Yeah.
So having a balanced portfolio of both stocks and bonds is one way that these target date retirement funds operate. It could also be a strategy that you employ personally.
Awesome. And usually is the interest on a bond like a fixed rate? Is that like before?
Yeah, these bonds are not really changing their interest rates over the duration. But the reason why people like them is for capital preservation and because it's giving them a form of, income in, coupons that are given to them over some cadence. Could be monthly, quarterly, or something like that until the bonds, mature.
Awesome. And I guess we could touch on this briefly as well. You hear a lot about like putting in money into a 401k for retirement. What exactly is a 401k and how much money should you be putting into it?
Yeah, good question. So everyone needs to save for retirement, right? Sticking a bunch of money under your mattress is not the way to do it. It's effectively the same thing as putting it into a savings account, except that you also got no interest. So it was like the worst option that you pick, right? Likewise, if we go to the other extreme and you put all your money into stocks, that may not be great come retirement if there's a downturn in the market, right? Because you were depending on that and now you can't liquidate those positions, right? So you need something that's going to be tax advantaged that will help you prepare for your retirement while, continually setting aside some money, right? Such that when your retirement comes, you've got this store of value that you can use, right?
Mhm.
But what if there were a way for you to contribute something to this fund, right? And also your employer to do it through the form of employer matching, right? That's a very common benefit in large tech companies for a 401k, right? It's part of the reason why people choose to not just like keep all the money that they're getting for their paycheck for themselves, right? All of the money that you put into a 401k can grow, a standard 401k, through the stocks that you invest in the 401k or the bonds or the mutual funds, any of that stuff, tax-free until the moment when you need to start withdrawing, right? The moment you start withdrawing, then you start paying taxes on it. There's a different kind of 401k called a Roth 401k, where it's after-tax money that goes in. So the after-tax money that goes in can grow now entirely tax-free, just like the 401k. But also, when it comes time for you to withdraw, you are still not paying any taxes because you already paid the taxes when you put it in, right? There are pros and cons to both approaches, right? With a standard 401k, that's normally what you're going to pick if you've got employer matching, right? Like they'll match up to 100% for $3,000 at the current limit of $20,000, I think, for your individual contributions, or they'll go up to 50 cents on the dollar if you hit all 20,000. So yeah, at the company that I'm in, right, Alphabet, we do that, right? Many other tech companies do, where they will match contributions that you put into the 401k up to certain, percentages. Not all companies will. Smaller startups won't. Larger unicorn-like companies probably won't either. So then it's up to you. You could decide that you're not going to put any money in the 401k. You're just going to have more discretionary income that's coming in that you can treat as your own invest spend, right? And that's totally okay too.
Cool. And can you have both a Roth and a Roth 401k and a standard 401k?
Yes, you can. So let's say that you are at one company, and at that first company, you had a 401k, right? Maybe because they had matching, or you just started your career and you didn't really know what the difference was, or maybe they just didn't offer a Roth option. That's possible, right? When you then go to your next role, you have a couple choices. You can keep that 401k exactly the way that it is, or you could do what's called a IRA rollover, where you turn that 401k into what's called an individual retirement account that's fully under your control, right? You can pick any stocks that you want to invest in, bonds, that kind of thing, and move it to a different financial institution. Or actually, I guess there's a third option. You could convert it into a Roth 401k, right? By paying a lump sum for all the taxes that you owe for the money that you put in that growth, right? And then in your new role, you could create a new 401k account that is in fact a Roth, so that now when you look at all of your, accounts, you have either a 401k or an IRA because you did the rollover, and now you have a Roth 401k. So that's possible too. It's also possible, if you haven't done the rollovers, to have multiple 401k accounts or multiple Roth 401k accounts because you just never did the rollover. I tend to tell people not to do that. The reason why is because when you're in, the company that you're in, and you're investing in a 401k plan, that 401k plan has an assortment or a menu of different things that you could invest in, because the company and the financial institution that's serving that 401k has allowed you to invest in those things, right? But beyond those things, you can't invest in anything else. So if you do the IRA rollover, you now have full control of all those assets, right? There are no restrictions in terms of what you can and cannot invest in. So that's why it's generally a good idea to do this rollover.
And so this is like when you switch companies, this is something that you need to do like manually on your own.
Yeah, it depends on the financial institution that you want to do the rollover into, right? But like Fidelity, for example, because I've worked with them for quite some time, was like, oh, okay, you're changing jobs. Would you like us to do a 401k rollover to you, or to your account, right? And I was like, oh, you can do that? They're like, yeah, we'll just turn it into an IRA. It'll be in your own account. You can pick whatever investments you want. I'm like, okay, chill, let's do that. So yeah, depends on the financial institution that you work with, but it's a well-known process with like standard documentation that you just got to fill out.
Cool. Thank you. That was very informative. Um, and earlier we were talking about kind of like bigger purchases in the context of credit cards. I guess just like as a general topic, um, we can go through kind of like the process of buying bigger um, bigger items, so such as like a car. Um, so yeah, first question is, when is the best time to buy your first car with your own money?
There's kind of a cheeky answer to this, which is when you need it. You got to drive somewhere, but I think a good time for you to buy a car is based on need, right? Like it's a cheeky answer, but like it's true. If you're in the Bay Area, and I don't know, you live in a town, you're not in San Francisco, you're probably going to need a car, or you're going to need the ability for someone to drive you around. There are other companies that will give you like commuter benefits, right? Where you can put in some money into a tax advantage account, and it'll come out of your paycheck, and you can use that for Lyft or Uber or something like that. But in aggregate, all of those rides are going to add up over time. They'll probably be more expensive than you just having a car, paying for gas, right? Now, of course, there's depreciation because it's an asset that you have that's going down in value, right? But the utility that you get from it, I think, is going to be way greater to you than if you were to just keep using rideshare everywhere. there are ways that you could keep the cost in check, right? You don't have to buy a brand new car. You could buy what's called a CPO car, certified pre-owned. Those cars were new when they were made, right? And some initial owner had them. But then after 3 or 4 years, that owner brings in that car, maybe because he or she wants to do a trade-in, or they just want to straight up sell it and get a different car. And then what the dealership will do is they'll do an inspection of the car and create an extended warranty for it. And that entire package, right? The inspection plus the extended warranty plus the car itself, that's part of the CPO, deal that you are buying into. So the benefit is that the first 3 years-ish of a car's life, that's when it's depreciating a lot, right? You don't have to be there for any of that depreciation because you bought the car after that point. So it's not depreciating as much. You've got this extended warranty, and another benefit might be too, if there's a lot of new tech features in this car, they've withstood the test of time, right? With a lot of the autonomy features that cars have nowadays, right? And my car did, my first car that I purchased, there are bugs, right? There are lots of things that are just not going to work, and you will now have the benefit of being able to look back through time and say, okay, this thing didn't work or this thing did. I'm willing to spend money for this feature in this car, or I'm not. And when you're buying a brand new car, you don't really have that research except for just your affinity to that brand.
I guess what should your budget be in terms of like percentage of total income?
Yeah, that's a good question. I guess it depends, right? If what really gives you happiness is driving around in your car, then maybe you're willing to spend more. But I would say in general, it should be low. A lot of people think as soon as they get that sign-on bonus and they see that their paycheck coming in, they're like, oh my God, I can go for this like awesome car, right? If you saved up for this car and you really want that car, like by all means, go for it, right? But I think it's better for you to try to keep your car payments as low as you possibly can. Search around for the best interest rate that you can on your loan. And if that requires you to, go to a different bank after you've created the loan with an initial bank, then go ahead and do it and transfer over, because that interest will add up over time, like in the hundreds of dollars, right? Also, if the car is expensive and you set aside, quite a bit of money for the, purpose of buying that car, maybe it's better to use a little bit more money and then have a lower principal on your loan so that per month you're not paying as much, right? That way, when you look at your paycheck coming in every single month, you're not losing as much as you would be if the loan, principal were higher because you paid less than the down payment. But yeah, I would say if you go for a CPO car, it's reliable, it's got this extended warranty, right? Like it's already going to be significantly less expensive than a new car that is of the same, model and make. And then on top of that, if there's, money that you set aside to be able to buy this car, that's purpose that you had for that money, so you might as well use it to keep your interest rate, to keep your monthly payments as low as you can.
Okay. Awesome. Yeah, buying a car, pretty big expense. But much greater is buying a house. So I guess this might also be kind of need-based, but when should you buy your first house if that's one of your goals?
When should you buy? I guess it's kind of like the car thing, when you want it. Yeah, let me see if I can think of a better answer to that. I mean, there are a few reasons, right? Maybe you believe that you need to diversify your investments and you need to get into real estate a little bit. That could be one reason why you want to do it. Maybe you want to have a family soon, so you're going to do it that way. Maybe you're just kind of tired of paying rents. That's another, very real reason for why people want to buy a place. Let's say that you've saved up enough for the down payment of a property, right? And you look at the cost of rent in your area, and then you look at the, economics of buying a house and what your monthly payments would be. Maybe it's a condo, so you've got an HOA, and property taxes, of course, whether it's a house, condo, townhome, that's going to be in play as well. It could be the case that using your down payment to buy the house or the condo, townhome, whatever it might be, is going to end up being cheaper for you month over month and still allow you to build equity. So here's an example just for like rough numbers, right? Let's say that you're spending $4,000 a month renting some apartment, right? You're not building any equity in that. It's just money that's kind of going away, right? But if you've got the money for the down payment in order to live in a condo, right? And your total cost is still going to be around $4,000, right? Because maybe your mortgage P&I, principal and interest, is around 3,400, 3,500, and then you've got an HOA cost that's 500 or something like that, right?
Yeah.
It's coming out to roughly the same, right?
Yeah.
Not only is it the same cost, right, but you now have the benefit of owning a place and building equity in it. It's a very good reason to buy a property, especially in an area that you believe in, and that you want to live in. So yeah, I guess that kind of answers the question. Was there anything like more specific that you were looking for?
No, that's perfect.
Okay.
And also, I guess what sort of factors should you consider when looking at various houses? I guess like city slash neighborhood is like an obvious one, but are there other less obvious things you should be looking for?
Yeah, a lot of people look at a place and they're like, oh my God, I love it. They just, want to immediately buy it, but they don't consider other things that they need to research. And that's a very good point that you raised, right? City versus neighborhood, sorry, city versus town is one major distinction, right? That you're going to know just immediately from appearance. And there are a lot of factors that are associated with that, right? Do you like driving in city traffic? Are you okay with like trying to find parking? Would you rather just be able to drive freely around your town and park in a parking lot in order to go to a supermarket, right? That would make a town better for you. Or maybe you have your folks coming over to visit or your friends come over to visit. It's constantly a pain for them to find parking. Maybe the town setting is a bit better for you. If on the other hand, you live in a building in SF where they have valet parking, maybe this isn't a problem, right? So that's one thing to consider. And just how you feel about city versus town living. Another thing might be, because I mentioned earlier that you're buying this place because you want to have a family. How are the schools in that area? Are they ranked very well? Are you going to have to send your kids to private schools, or are you okay with the public schools? How do you feel about commuting to school with your kids near, your office? Is that reasonable? Or are you going to be backtracking across multiple cities and towns in order to be able to do it? Those are, a couple other factors. Let's see, what's something else you consider? Oh, of course. Property real estate values going up or going down, right? If you buy in a region where everything looks good on paper, right, at that time, but you look at the neighborhood and you're like, it's not really growing, it's kind of stagnant, like your property is probably not going to go up in value. And then you're going to have to decide, like, am I buying it because I really love this place and I want it to be my forever home? Or would I like it to actually go up in value, right?
Yeah.
And most homeowners are somewhere inside that spectrum. None of them that I can think of, except, for ones that are investing in secondary properties, would be solely in the, I just want it to go up in value. I don't really care what it looks like. I'm just going to live in it category, right? And then on the other end of the spectrum, there's, I really don't care what happens to its value. It's my forever home. I want to live in it, right? Most people are somewhere inside the spectrum. They're not on either end of the spectrum, right? Which means by that argument, they should care what the property value is going to be like at some point. And I think it's an important thing to keep in mind anyway, because if you ever want to upgrade, if there's equity that you built up in your property because it rose in value over time, you want to be able to use it. You want to be able to like funnel it into the next down payment for another property or something like that.
Also, I guess on that topic, I touched on it briefly earlier in regards to like monthly payments, but what is a mortgage? Where can you get one? And what are also some factors to consider when looking at?
Got it. Okay. So let's take a step back and let's imagine that you have just like gobs of cash, right? You find a place that you really like and you're like, you know what? I can just use cash to pay for all of this. And that's something that you want to do. Fine. No mortgage necessary. That's an option available to you. But for most people who don't want to do that, right? They have to go to a bank and they have to say, please write me a loan so that I can purchase this property, right? That loan is the mortgage. That's I don't remember when that term was first like coined, but that's basically what we came up with. This mortgage is effectively a loan that allows you to buy your property, right? Live in it, grow equity in it, but you're consistently paying, interest and principal on this thing because it's well a loan, right? The bank has to be able to make some money from giving you this loan. So there are many different kinds of mortgage loans that are available to you. They have different structures. And based on their structure, there could be more upfront costs, less upfront costs. There could be more per month costs, less per month costs, right? The length of the mortgage could be different depending on the different financial institution or which mortgage package you're going for. And there could be other benefits that are associated with it too, right? Maybe if the bank is using relationship client pricing, they're willing to offer you a much lower interest rate than any other bank, but you have to deposit some amount of money with them and they have to be your primary direct deposit, whatever it might be, right? So lots of flavors, shapes, and sizes for you to choose from in terms of your mortgage. And like I was mentioning earlier, a mortgage is something that a bank is going to run a hard inquiry credit check on. So it's going to hurt your credit initially, right?
Yeah.
There is a benefit though, which a lot of people don't know about. If you search for all your mortgages within 14 days, and this happens too for car loans, what credit agencies can do, credit reporting agencies, is they can take all of those hard inquiries that those banks made and lump them into like one hard inquiry so that it only hurts your credit score once, right?
Yeah.
If you go outside of the 14-day window and you check with another bank for a lower rate, it is going to record itself as another hard inquiry check on your credit report, and that will drop it a bit lower. But it might be worth it, right? If that other bank thinks that they could offer you a better interest rate and you do the math and you're like, oh my God, this is, $400 more per month that I'm saving, right? It's mine, it's in my pocket. Like maybe it's worth it for you to take that credit score hit. And it won't go down by much, maybe like 20, 30 points, and it'll start coming back up again.
Awesome. Thank you for those tips. I guess something we can briefly touch on is taxes. This will only apply for US taxes specifically. But what are the different types of tax forms, like a W-2, 1099? And what should you submit with your taxes every year?
Yeah, good question. This is another thing that I write about actually in my blog, because I get a lot of questions from new grads about like, okay, but like what happens after the first year? What do I walk away with? And I'm like, all right, let me explain it. So what's normally going to happen when you first begin your career is you're going to get this fat sign-on bonus, right? Because you negotiated it or because the company gave it to you, and you're like, great, awesome, I'm so much richer now, right? And then you see the paycheck, right, that comes in with that bonus statement, and you're like, what? I got so much less than the bonus. What happened, right? That's because your bonus got taxed. So you're not going to get the full value of your bonus initially. There's going to be a large chunk of it that's taken out for taxes. And then what's going to happen in the following year is the IRS is going to calculate how much you owe in taxes. And what they're going to find, most likely, if you didn't do a bunch of stock transactions or something else that would be outside the norm, like you were just getting income from your job, is you don't actually owe taxes. Maybe they overtaxed you, right? Because they took out that huge chunk from your bonus. So what's going to get submitted to the IRS from your employer is a form that basically says, this is everything that we paid to you in the form of bonuses, RSUs, standard cash compensation. This is how much was taken out for the 401k and any other benefits, right? This is how much we withheld for taxes. And you're going to have another form as well called a W-2 that the company will generate for you that shows all that information as well, right? There's like, it used to be the case that you would cut out like portions of it, and there would be paper copies that would be sent to the IRS, to your local, state franchise tax board, and then one copy for yourself, right? That standard format has been maintained even now for PDF. So you'll actually see like 3 columns, even if they have the same data on them for the stuff that I mentioned, right? Your total compensation in the form of cash, bonuses, RSUs, how much you contribute as a 401k, how much the company withheld in taxes, all of that's going to be submitted to the IRS, right? So you're going to submit a W-2 to the IRS. And if it's also your first year just out of college, there's probably going to be what's called a 1099-T, 1099 tuition form. And what that form shows to the IRS is how much you paid for tuition to attend a university, right? This is another thing that could give you a refund, because the IRS, basically says, oh, look at that, this was a student. They paid a bunch of money to attend university. We should give them some of that money back if, we tax them a bit too much. There's another form called a 1099 int. That's 1099 interest. So remember how we were talking about the checking and savings accounts? If they're generating interest for you and it's above a certain limit, then those banks are going to generate what are called 1099 int forms for you that will also be submitted to the IRS and to your local state tax board. If they're under a certain limit, then they're what's called de minimis, and they basically mean, you made interest, but like it's so little, we're not going to tax you. There's another 1099 form called a 1099 div. That stands for 1099 dividend, right? So if you've got dividends from stocks, then your brokerage firm is going to generate that form for you. And then there's another 1099 called a 1099B. That's 1099 brokerage. So if you've been selling, let me say it a different way. If you've been buying shares or you've been selling them, this is still stuff that's going to be reported, right? But the stuff that you have a taxable liability for is when you are selling, right? That could come in the form of either capital gain or capital loss. If it's a capital gain, then the IRS basically says, oh, you made money, so we could theoretically tax this, right? And if you made that money by holding that asset for less than a year, then they treat it as ordinary income and it's taxed at exactly the same tax bracket that you would have for your ordinary income. If you held that asset for more than 1 year, then it's better, it's advantaged. It's called long-term capital gains. And there are different tiers, but I think the highest one right now is 20%. Most new grads are not going to hit that because it's based on quite a large amount of income. So yeah, those are the main forms. Let me think, are there any other ones that you might have? A W-4 maybe to explain tax withholding to your employer. I think those are probably the main ones that a new grad would be dealing with. There are other forms that you might have if you had like real estate investment properties or that kind of thing. But yeah, that's not really a thing that most new grads would have.
Okay, awesome. And when should you start like getting all these together to submit?
Yeah, good question. So you've got probably by the time that you graduated from university, a few different things going on. You've got student loans, maybe, if you haven't paid them off. You've got all these different bank accounts, maybe because your parents opened up, some accounts for you when you were a kid at a credit union. And then you opened up one later, maybe at a brokerage firm because you wanted to do some stock trading. And then of course you've got forms that are being generated by your company and given to you, right? So all of these forms that have to get generated are going to have to get generated by the companies or the businesses or entities that serve them, right? Not by you. So it's not like you were manually creating a W-2 or something like that. So the good news is that you basically just have to wait for these documents to come in. You'll get email notifications or they'll send them in the mail. And as they start coming in, you can start kind of putting together like a tax package for yourself, right? Tax prep software like H&R Block or Intuit's TurboTax will then start asking questions of you to figure out what forms you need to actually submit, right? And one of the good things with digital reporting nowadays is that W-2s can also be sent to the IRS in a digital form. They don't have to be paper. So it's not like your company is, sitting in their mailroom, like, stamping like thousands of envelopes to be able to send to the IRS. They could just digitally send all those. And then TurboTax will ask you for, last 4 digits of your SSN and maybe how much you paid in taxes the prior year to establish your identity. And it will then say, okay, I've identified that this is in fact the taxpayer name's, John Smith. And these are the tax returns that have been digitally filed in the prior year. For this year, this is the W-2 that I can attach to the tax form because it's already been filed by the employer. And if I can't find it, I'm going to ask the user to like upload it as a PDF to me, right? Your 1099 ints, divs, and Bs, right? Those, it really depends on the financial institution. Not all of them can be imported into TurboTax or H&R Block, but all of them have to generate the form for you, right? So if you've got the form and TurboTax like can't let you upload it or H&R Block can't let you upload it, then you have to sit there and manually enter all this information, right? Like every time that you sold, some number of shares, how much were they sold for, how many, what date, and that can be really cumbersome. But yeah, the good news is that most financial institutions nowadays have a format that can be like digitally parsed by the IRS, by the tax prep software. So that's all good. So TLDR is you need to wait for the documents to come in. Once the documents have come in, they may have been digitally filed, or you're going to have to upload them as part of your tax prep, form. But I generally start the process in like January or February. January is normally when a lot of companies have W-2s that are prepared, if they're simple, right? Like you don't have stock options and other things that they have to keep track of. And February is normally when a lot of brokerage firms will then say, okay, we're starting to tabulate everything that you did. Maybe we're waiting on some other form to give us, some other fund to give us their tax forms, but they'll tell you when they expect all those things to come in. The one thing you do not want to do, though, is you do not want to file like close to the tax filing deadline, because there are probably things that are going to go wrong, right?
Yeah.
All the tax prep software is heavily oversubscribed at that point. You might have super long, delays, or maybe if you've got to send something physically into the IRS, it could get lost and you might have to deal with that. So just try to do everything early, plan it out ahead of time, and you'll be good to go.
Awesome. Thank you. That was lots of useful information. So yeah, I guess we can just start closing. Are there any sorts of resources that you have found to be helpful or like to share? I know you've shared like Mint, TurboTax, a few of the other ones. Are there any other resources that you have found helpful?
Sure. NerdWallet is very good for learning a bunch of financial information. Investopedia is also great too. And I think beyond that, just try to be curious, right? If you're hearing things at work that you don't really understand and they're related to, your compensation or the financial markets, like ask, right? We actually had this cohort, our new grad cohort in my first role, right? Where we were just like struggling for the first couple of months, trying to figure out just like, what is this adult landscape that we've entered, right? Like we have to pick medical benefits, dental benefits, like eye care, like what, which plan did you all pick? How much are you putting into your 401k? All of this is like a ring of fire that you just kind of have to jump through as you're an adult. But by putting the foundation down now to start understanding how this all works, it's going to be a lot easier for you when you enter the workforce to just not have that mental load that you have to deal with, right? Because you're trying to like get adjusted to your job. You're trying to like become an adult who's paying rent and, making food maybe for the first time. And now you got to deal with this. So yeah, stay curious, run Google searches, ask people for things at work. Seek out mentors, right? And especially mentors that you can develop very close personal relationships with, who are not just professional, right? Ask them questions about finance if you don't understand it, and preface it by just saying like, I want to be respectful and make sure that I'm not asking you something too personal, but like there's something that I don't really understand as a new grad, like would you be able to help me, right? And more often than not, people are gonna want to help you. There's this interesting psychological trick that happens when you ask someone for help that creates a closer connection to that person, right? In reverse towards you. That person is like, oh, I'm important to this person in their life. So try it out, see how it goes. Lastly, just as a selfish plug for myself, the blog that I have called buildermentality.com is all about this. I try to focus on things that are going to be helpful to new grads and young professionals who are just beginning their career. Primarily for engineers, but also for people who are just interested in finance and investing in general. The things I discuss are things like how do you weigh different offers, how do taxes work, how do RSUs work, how do you deal with like time productivity when you're being pulled in like all sorts of different directions. There's even a post on how to buy a car, as well as my experience in buying my first place, my condo. So yeah, check it out, see how it goes. But yeah, those are my closing remarks.
Awesome. Again, thank you so much, Devan, for your time, sharing your perspectives and experiences with all of us today. And thank you all for watching this episode of UPE Podcasts. We will be having more podcasts in the future, so watch out for those when they're released on our YouTube channel. I was your host, Dylan, and I hope you enjoyed.
Thanks so much for having me, Dylan.
Thank you, Devan.